One of the problems in DCF valuation amongst estimating the expected cash flows is to come up with a reasonable estimate of the required rate of return. The required rate of return is an expected return which the final valuation is crucially dependent on. And picking a suitable required rate of return is both art and science. We can say that different approaches are used when choosing a required rate of return, depending on whether it's a listed public company or a private firm we're dealing with. For publicly listed firms, practitioners use pricing models, among which we find a popular choice, at least for financial analysts, called CAPM, which stands for Capital Asset Pricing Model. The CAPM is a pricing model which has been developed to describe the relationship between risk and return. Although the CAPM is being widely criticized, it's probably the only approach that has had a meaningful response both in the academic world and from the business practice. According to this model, the required return on a risky security depends on two components: a risk-free rate, one can find on treasury securities issued by primary credit-worthy governments, and the risk premium that depends both on the amount of non-diversifiable risk and the expected return on the market portfolio. The CAPM is depicted using this equation, where ER is the required rate of return on a given I security, RF is the risk-free return, beta is the non-diversifiable risk component, RM is the expected return on the market portfolio. The two unknowns in this equation are the expected return on the market portfolio and the beta. Of course, practitioners use historical data to come up with reasonable, albeit uncertain, estimates of these two variables. The capital asset pricing model requires a rigorous statistical and mathematical approach. Historical data are widely available for listed public companies, whereas for private firms, one needs a more practical approach. Consider a private equity firm whose general partners like to classify the business opportunities that they seek in three bins: one for low risk, one for medium risk, and one for high risk. Each bin is associated with its respective required rate of return: 10% for low risk, 25% for medium risk, and 33% for high risk. Risk is inherent in all projects whose future cash flows can't be predicted with enough confidence. In our example's private equity firm, the level of experience in the company's industry can be used as a proxy for the risk associated with the project. On the contrary, a project within an industry the general partners are well experienced in can be classified into a low-risk profile. And finally, a project that neither falls in the low-risk nor in the high-risk classes would be categorized as a medium-risk project. Although this approach can look reasonable, it lacks the quantitative characteristics that a financial model should feature. Based on which criteria should we assign low-risk projects to a 10% required rate of return? This is not described in our model and might as well be a rule of thumb the general partners follow as a shortcut to simplistically sort out the issues that valuation imposes. Within the CAPM model, a security's risk profile is embedded in its beta. High beta means high risk, low beta means low risk in this model. Beta is high when it's larger than 1. Beta is low when smaller than 1. For a security whose beta is larger than 1, we use the term aggressive, whereas for a security whose beta is smaller than 1, we use the term defensive. Consider this example where the risk-free return is 1%, the expected return on the market is 9%, and the target security's beta is 1.5. The risk premium component in the required rate of return would be 1.5 times 9 minus 1, that is 12%. The expected return on the security would therefore be 13%. Consider this other example where the risk-free return is always 1% and the target security's beta is 0.5. The required rate of return or expected return on our target security would therefore be 5%, i.e. 1% plus the risk premium component, which is 4%. The art and science of valuation requires defining an expected return which is dependent on an assessment of risk. In the CAPM, one can estimate a security's beta by taking the ratio of that security's historical standard deviation to the market portfolio's standard deviation and adjusting it with the correlation between the securities and the market portfolio's historical returns. Although the CAPM rests on sound assumptions and a rigorous approach, one can find that by estimating the unknown variables using historical returns, a lot of noise or unexplained variation will remain in place. The private equity firm approach still retains a practical appeal, though it lacks a theoretical foundation.